We run a business with offices based in Melbourne and the UK, and personally I've been based in the UK for a while now. And I think the big insight we could probably give people here in Australia about what has happened and what may happen going forward is that ultimately the Brexit vote, you essentially had an economic argument that where it's a slam dunk to stay in the European Union, but it was clouded by things such as immigration and globalisation. And so ultimately you have an anti-immigration, anti-globalisation vote here, which has essentially created a non-economically positive outcome for the UK, and it will also potentially have knock-on effects to Europe. And I think now that that's happened, people should try and think about what are the positive and negative consequences of that. So the good scenario is that, okay, so the UK have clearly made a non-economically positive decision for them in the short term. In the long run, it might be the right choice because Europe may fragment from here. But in terms of the short term, ultimately we know from the campaign that the established political institutions would have loved the UK to stay in the European Union, and they want the European Union to stay together. So the positive scenario from here is unfortunately for the UK to suffer quite badly, and for the European Union to become stronger out of this. And so for people to see that the UK has left, and so the European Union becomes stronger, the euro becomes stronger, and in the US the leanings towards protectionism and anti-globalisation with the Trump campaign take heed of what's happened and create the positives and basically move back towards centrist politics. The other thing that obviously happens is interest rates stay lower for longer, which will support the yield component of equity markets and the yield component of asset prices. So ultimately, risk assets look better in that environment. That's the positive outcome. And so the bear case is that people look at what's happened in the UK, and so ultimately we have a political movement here that has done a non-financial market friendly outcome, and something that financial markets quite frankly did not predict. And so that is essentially challenging the established status quo. So what you need to watch very closely, or what we're watching very closely, is the other political movements in Europe that are occurring in France through the Le Pen movement, in Austria, in Holland, in Spain, in Italy. And so ultimately, people have a view that the European Union may fragment, and I have some sympathy with that view. And ultimately, you need to watch that quite closely, because for the UK to leave the Union is reasonably easy. They have their own currency. Well, not reasonably easy, sorry, reasonably easy versus Europe. They have their own currency, they have their own central bank, they have their own political framework. If one of these other countries in Europe decides to leave, then we're essentially moving towards the Greece outcome that we saw in 2011, a fragmenting of the currency union, and then ultimately the reserve currency, the euro, will essentially come into question. So there's a plausible but not probable path to people again questioning the euro, if that makes sense. And markets will have to price that in. And that's not a growth outcome, that's simply a reserve currency issue outcome, and something that's very, very hard for us to value at this point in time. So the base case is, from our point of view, is okay, clearly we don't know. Most of us got the UK vote wrong. And so there is a element here that is essentially not rising up, but essentially is anti-capitalism to a certain extent, and markets should take case of that. Just point a note of that. The other thing we'd say is ultimately the market is basically back where it was last Monday. The US market is only 3% off its high. And so ultimately, markets are being reasonably complacent here. And so there is an argument to just quite frankly move to the sidelines until the weather gets better. We don't know, but essentially something's gone wrong here. This could create a domino effect. We don't know, it's not likely, but it's potential. And ultimately where markets are and where valuation is, it makes sense to us to step slightly to the sidelines at this point in time. And that's what we'd be doing with our investors at the moment, and what we're doing with our clients' money.